3 months ago, a woman named Patricia walked into a mortgage lender's office with a credit score of 621. The loan officer gave her the answer she was expecting. She could qualify for a mortgage, but the interest rate would be harsh, nearly 7% on a 30-year loan. On a $350,000 home, that rate would end up costing her more than $180,000 in additional interest compared to someone with excellent credit. Patricia then asked if she could take 90 days to improve her score before locking in the rate. The officer agreed with a polite smile, but cautioned her not to expect dramatic results. Credit scores, he explained, usually change slowly, and a few months rarely make a meaningful difference. 93 days later, Patricia came back. Her credit score had risen to 761. The loan officer even asked whether she had accidentally submitted the wrong Social Security number. She hadn't. Patricia had simply learned about a little-known mechanism built into the credit scoring system, one most consumers never hear about, even though banks and credit card companies understand it perfectly and have little reason to explain it. That 140-point increase ultimately saved Patricia more than $215,000 in lifetime mortgage interest. Same house, same income, same person, but different knowledge. What she discovered wasn't a trick, loophole, or scheme. She didn't dispute accurate information or exploit technical errors. Instead, she used a legitimate feature of how credit scores are calculated, something hiding in plain sight, yet rarely discussed because the financial industry benefits from keeping it obscure. In this video, you'll learn exactly what Patricia uncovered. By the end, you'll understand why the common advice that credit takes years to build is technically correct, but, in practice, often misleading. There's actually a faster path the system allows, one that almost nobody talks about. To understand it, we first need to look at why the traditional advice about building credit often keeps people stuck longer than necessary. The standard guidance sounds familiar. Pay your bills on time, keep balances low, avoid opening too many new accounts, and be patient. Wait years, sometimes decades. Let your credit history mature slowly, and eventually your score will reach the excellent range. That advice isn't incorrect, but it's incomplete in a way that heavily benefits lenders. Every month you remain in the fair or good credit tiers instead of excellent quietly costs you money. Higher credit card interest rates, less favorable auto loan terms, more expensive mortgages, increased insurance premiums in many states, and larger apartment security deposits all add up. This credit score tax affects those who can least afford it the most, and the slow, conventional approach keeps them paying it far longer than necessary. Banks profit from this extended timeline. A borrower with a 680 score who could realistically qualify for a 780 is simply more profitable. They pay higher rates and generate more interest revenue, giving lenders little motivation to help them improve quickly. The strategy Patricia discovered centers on something known as Authorized User Trade Lines. To understand why this works, you first need to understand how credit scores are actually calculated. At its core, a credit score is a statistical prediction, an estimate of how likely you are to default on a debt within the next 24 months. The scoring algorithm analyzes your credit history by comparing your behavior to millions of other consumers. It looks for patterns linked to default risk, as well as patterns associated with reliable repayment. The most influential factor is payment history, whether you consistently pay your bills on time. This makes up about 35% of your credit score. The second largest factor is credit utilization, meaning how much of your available credit you're currently using, which accounts for roughly 30%. Here's where things become especially interesting. The third major factor is the length of your credit history. This includes the age of your oldest account, the age of your newest account, and the average age across all your accounts. Together, These elements contribute about 15% of your score. Most people assume credit history length is purely a matter of time. If you opened your first credit card at 18 and you're now 30, then you simply have 12 years of history. Nothing to accelerate, nothing to change, just time passing. But that assumption isn't entirely correct, and that misunderstanding is exactly where the opportunity exists. When you're added as an authorized user on someone else's credit card, the full history of that account can appear on your credit report. The account's age, payment record, credit limit, and utilization may all be reflected in your profile as though you had been associated with the account from the start. Consider the implications carefully. If your mother has a credit card she opened 23 years ago, maintained perfect payment history on, and kept at low utilization, and she adds you today as an authorized user, that 23-year-old account can immediately show up on your credit report. Overnight, your average account age could shift dramatically. For example, jumping from 2 years to 12 years. Your total available credit can suddenly double or even triple. Your oldest account could appear decades older overnight. That's exactly what Patricia did. Her mother had 3 credit cards with a combined history of more than 40 years, flawless payment records, and utilization below 5%. Patricia was added as an authorized user on all 3 accounts. Within 2 billing cycles, those accounts appeared on her credit reports. What once looked like a thin credit file now appeared strong and well-established. Her short credit history instantly looked seasoned, and her score rose by 140 points. This authorized user strategy isn't unknown within the credit industry. Mortgage brokers understand it. Credit repair companies use it. Banks certainly know it exists. Yet, it's rarely promoted to consumers because there's little financial incentive to help people leave high-interest categories quickly. Consider another example that shows how this works in a different situation. Marcus, age 24, had a credit score of 589. During college, he missed several payments and maxed out a store credit card during a difficult semester. When he tried to finance a used car, every dealership offered loan rates above 14%. His grandfather, however, had credit cards dating back to 1987, spotless payment history, combined limits exceeding $60,000, and utilization consistently under 3%. Marcus's grandfather added him as an authorized user to his 2 oldest cards. Marcus never received a physical card or access to the accounts. The move was purely strategic. Within 60 days, Marcus's credit report reflected accounts showing 37 years of perfect payment history. His average account age increased from 2 years to nearly 19 years. His available credit tripled, and his score climbed to 697, high enough to qualify for auto financing at about 6% instead of 14%. On a $25,000 car loan over 5 years. That difference saved Marcus nearly $5,200 in interest. A simple action that took his grandfather about 10 minutes online effectively transferred decades of credit credibility almost instantly. Now, let's go through how to apply this strategy correctly, because the details matter. First, the account you're added to must be in good standing. Ideally, the account should have a flawless payment history. Even a single missed payment can do more harm than good. Credit utilization should be low, preferably under 10%. Older accounts carry more weight, so the longer the history, the better. A high credit limit combined with a low balance strengthens the effect even further. Second, the primary account holder must be willing to add you. In most cases, this means a trusted family member or a very close friend. They're essentially allowing their positive credit history to appear on your profile, which requires trust that you won't misuse any card access they might provide. In fact, many authorized users are added strategically without ever receiving a physical card. Third, not every credit card issuer reports authorized user accounts to all 3 credit bureaus. Major issuers such as American Express, Chase, Bank of America, Capital One, and Discover generally do report authorized users, while some smaller banks and credit unions may not. Verifying reporting practices beforehand is essential. Fourth, the impact usually appears quickly, often within 1 or 2 billing cycles after you're added. There's no need to wait months or years. Once the issuer reports the account, its history is incorporated into your credit profile almost immediately. Fifth, authorized user status can be removed at any time. When that happens, the account will eventually disappear from your credit report, which keeps the risk relatively low for the primary account holder. If circumstances change, they can simply remove you from the account. The size of the score increase depends largely on your starting point. Individuals with thin credit files or short histories typically see the biggest improvements. Patricia, for example, had only 2 accounts of her own, both under 3 years old. Adding 3 accounts, averaging 14 years in age, dramatically reshaped the age profile of her credit history. Someone with an already established file may see smaller, but still meaningful, gains. Even increasing an average account age from 7 years to 12 years can add roughly 20 to 30 points. At this stage, the obvious question is whether this is actually allowed, and whether it's legitimate. The answer is clearly yes. Authorized user accounts are intentionally included in credit scoring models. Both FICO and VantageScore incorporate them into their calculations, and the practice is fully legal and formally recognized by the credit bureaus. So why does the system work this way? Originally, authorized user reporting was designed to help spouses build credit together. In many households, one partner managed the finances and opened accounts solely in their own name, leaving the other partner with little or no credit history despite sharing financial responsibility. Authorized user status solved this issue by allowing the financially active partner to share their account history. Over time, people realized the mechanism wasn't limited to spouses. Parents could help their children establish credit, and, at least mechanically, one person could assist another by adding them to an existing account. Credit bureaus saw little reason to restrict the practice because it reflected a legitimate financial relationship. Some critics have argued that this functions like a loophole that should be closed. However, the credit industry has largely avoided major changes, partly because altering authorized user reporting would introduce complications and unintended consequences. As a result, the strategy remains fully operational today. That said, there are important limitations to understand. Certain mortgage lenders closely examine authorized user accounts during underwriting. In manual reviews, lenders may discount or ignore those accounts even if they positively influence your credit score. Automated underwriting systems, however, often accept the score as calculated, which is what happened in Patricia's case. Authorized user accounts may also carry slightly less weight than primary accounts in some scoring models. Over the years, FICO has adjusted its algorithms to reduce the impact of accounts where you are not the primary borrower. The benefit remains meaningful, just less dramatic than it was a decade ago. Another consideration is dependency on the primary account holder's behavior. If they miss payments or significantly increase balances, your credit score can suffer as well. Choosing the right person, ideally a family member with a long record of responsible credit management, is therefore critical. Beyond authorized users, the credit system contains other mechanisms many consumers fail to fully leverage. The second involves understanding exactly when credit utilization is measured and reported. Your utilization ratio, the percentage of available credit you're using, accounts for roughly 30% of your credit score. Conventional advice suggests keeping utilization below 30%, while more advanced guidance recommends staying under 10%. In practice, the optimal range is often between 1% and 3%. Here's the key detail most people miss. Utilization is based on the balance reported to credit bureaus, which usually occurs on the statement closing date, not the payment due date. You might pay your credit card in full every month and never incur interest. But if you regularly charge $2,000 on a card with a $3,000 limit and that balance appears on your statement, your reported utilization is 67%. From the scoring model's perspective, that signals higher risk, even though you pay responsibly. The adjustment is simple but powerful. Pay down your balance before the statement closing date rather than waiting for the due date. For example, reducing the balance to $50 before the statement closes results in reported utilization under 2%. That single timing change can produce a 20 to 40 point increase in your score almost immediately, without changing spending habits at all. This timing adjustment works quickly. You don't need to wait months to see results. Pay down your balance before this month's statement closing date, and the lower utilization will typically appear on your credit report the following month. The third overlooked mechanism involves credit limit increases and their surprisingly strong effect on your score. Credit utilization is a ratio. You can improve it either by lowering the numerator, your balances, or increasing the denominator, your total credit limits. Most people focus only on paying balances down, while the credit limit side of the equation is often ignored. Many credit card issuers allow you to request credit limit increases without triggering a hard inquiry on your credit report. American Express is especially known for approving increases through its app or website using a soft pull, which does not negatively affect your score. Increasing your limit can immediately improve utilization simply through math. For example, if you carry a $2,000 balance on a $5,000 limit, you're using 40% of your available credit. If that limit increases to $10,000, your utilization instantly drops to 20%, even though your spending hasn't changed. Because scoring models evaluate ratios, your score can improve purely from this structural change. A practical strategy is requesting limit increases across your cards every 6 to 12 months. Each approved increase strengthens utilization metrics and expands total available credit. Over time, someone who started with $10,000 in combined limits could grow to $50,000 or more simply by making periodic requests. Banks rarely promote this option openly. While higher limits can encourage spending, they also lower utilization and improve credit scores, which may allow customers to qualify for better loan terms elsewhere. From a lender's perspective, maintaining moderate limits often preserves profitability. The fourth mechanism involves strategic account management, an area where many consumers misunderstand the conventional advice. You've probably heard that closing old accounts always harms your score, leading people to believe they should never close anything. The reality is more nuanced. That advice is partly true, but often misunderstood. What really matters is the age of your oldest account and your average account age across all accounts. Closing a newer account can sometimes improve your average age, while closing your oldest account almost always damages it. A strategic approach means identifying which accounts genuinely support your credit profile and which ones don't. For example, a store card opened 2 years ago for a one-time discount may add little value and could even lower your average account age. In contrast, your oldest credit card should typically remain open indefinitely, even if you rarely use it. Many people keep every account open out of fear, accumulating retail cards and miscellaneous accounts that add complexity without meaningful benefit. Periodically reviewing your accounts, deciding intentionally what to keep and what to close, can optimize your score while simplifying your financial life. The fifth overlooked mechanism is something called rapid rescoring, a process most consumers don't realize exists. During a mortgage application, timing becomes critical. Under normal circumstances, Improvements to your credit profile take 1 or 2 billing cycles to appear on your report. Rapid rescoring allows certain updates to be reflected within days instead of weeks. Here's how it works. Your mortgage lender can request that credit bureaus update specific items immediately based on verified documentation you provide. For example, if you pay off a credit card balance and submit proof, the updated zero balance can appear on your credit report within roughly 72 hours, rather than waiting for the next statement cycle. Rapid rescoring isn't available directly to consumers. It can only be initiated through a lender during an active mortgage application. But knowing it exists allows you to time your credit optimization strategically. Improvements made right before or during the mortgage process can have an immediate impact instead of fading months earlier. This creates opportunities for significant last-minute gains. Someone who pays off a $5,000 balance mid-application may see their updated score before final approval. Likewise, becoming an authorized user on a strong account can sometimes be reflected within days rather than weeks. When multiple strategies are combined under rapid rescoring, score increases of 50 to 80 points during the application process are possible. Before outlining the action plan, it's important to understand the mistakes that most often undermine these strategies. The first mistake is choosing the wrong authorized user account. High utilization accounts can hurt rather than help. Any missed payments in the account's history will transfer negative signals along with the positive ones. And accounts that are only a few years old provide limited benefit if your own accounts are already similar in age. Careful vetting is essential before being added. The second common mistake is applying for new credit while implementing these optimization strategies. Each hard inquiry temporarily lowers your score by about 5 to 10 points. Opening a new account also reduces your average account age. Many people unknowingly sabotage their optimization efforts by opening new accounts at the same time they're trying to improve their score. The third mistake is inconsistent timing with utilization management. Paying before the statement closing date only works if you do it consistently. 1 month of high reported utilization can wipe out months of careful optimization. Setting calendar reminders a few days before each statement closes is a simple but effective solution. The fourth mistake is impatience. These strategies take effect within 1 to 2 billing cycles. It can feel slow if you're anxious about an upcoming application, leading some people to abandon the process too soon. Trust the timeline and verify results by checking your reports after 2 full billing cycles. Here's a comprehensive action plan tailored to your starting score. Credit score below 650. The authorized user strategy offers the largest potential boost. Identify family members with old accounts, excellent payment history, and high limits, and request to be added on 1 to 3 accounts. Address any negative items on your report through proper dispute channels for inaccurate entries. Pay down credit card balances to below 10% of your limits before the next statement closes. Score between 650 and 720. You're in the optimization zone where multiple small improvements add up. Request credit limit increases on existing cards. Adjust payment timing to reduce reported utilization. Use the authorized user strategy if your file is thin or accounts are young. Consider goodwill removal for old negative items if you have a history of responsible payments with that creditor. Score above 720. You're likely fine for most purposes, but optimization still matters for the best mortgage rates. Even a jump from 750 to 780 can translate into significantly better interest rates. Focus on utilization timing, credit limit increases, and maintaining the positive patterns already established. Regardless of your starting point, everyone should pull free credit reports from all 3 bureaus annually and review them for errors. Studies consistently show that a meaningful percentage of credit reports contain mistakes, some large enough to affect scores and loan eligibility. Disputing legitimate errors should always happen alongside the other strategies. Here's the deeper truth. The credit scoring system exists to predict risk for lenders, not to help you manage your financial life. It was designed to determine how much banks can charge you. The system reveals some information and hides other details in ways that primarily serve institutional interests rather than your own. Banks don't explain the authorized user strategy because it lets you escape their high-interest products faster. Credit bureaus don't publicize the timing of utilization reporting because keeping it obscure drives reliance on credit monitoring services. The industry profits from the belief that credit improvement is slow, mysterious, and sometimes requires paid assistance. The truth is that credit scoring follows mechanical, knowable rules. Once you understand them, you can optimize your profile. The difference between those who understand the system and those who don't translates directly into long-term financial outcomes. Someone who maintains a 780 score instead of 680 will pay dramatically less over their lifetime. Lower mortgage and auto loan rates, better credit card terms, reduced insurance premiums, savings that compound over decades. These strategies work because they operate entirely within the system's rules, not outside them. You're not cheating, and you're not exploiting glitches. You're simply using features that exist by design, but aren't advertised by institutions that profit from your ignorance. Patricia's 140-point jump in just 93 days permanently altered her financial trajectory. The $215,000 she'll save in mortgage interest could fund her retirement, and the knowledge she gained applies to every credit decision she'll make for life. That same knowledge is now available to you. This loophole isn't hidden because it's illegal or unethical. It's hidden because nobody with a profit motive benefits from you knowing it. Now you do. How you use that knowledge is entirely up to you.